Okay, welcome back, everybody, to the Four Star Podcast. Chris Reardon and I here are welcoming our good friends back to the podcast. We're fortunate to have with us Eric Lewis, who's Vice President of Sales and a good friend of Four Star, Vice President of Sales at JP Morgan, and the esteemed David Lebovitz. And David is a global market strategist for JP Morgan Asset Management. And we've heard from these wonderful guys before. We have a very different story now than before. World's changed a lot. So we're going to get into it and have a nice discussion about what's going on in the economy. So welcome, guys, to the podcast.
Yeah, thanks for having us.
All right. Well, good. Well, when we last spoke, we were in the middle of a pandemic or coming out of a pandemic. We're still kind of coming out of a pandemic, but it seems like it's waning a little bit, but there's still some effects from it. So Mr. David, what thoughts do you have on where we are today as we enter the new year?
Absolutely, it's been a bit of a moving target, if you will, over the past couple of weeks. If we had been having this conversation at the beginning of December, we were very much of the view that the solid economic momentum we saw in the fourth quarter of last year was going to carry over to the first quarter, potentially even the first half of 2022. And we were looking at a year of, again, above trend economic activity. Then what happened about 2 weeks out from the end of 2021? Well, Omicron showed up and knocked on our door. And, initially we didn't really know what to make of that. But over the past few weeks, we have seen a notable impact on some mobility statistics, things like the number of people passing through TSA checkpoints, the number of people going out to dinner, the number of people staying in hotels. And furthermore, just looking at the consumption mix, we've seen people reorient themselves and consume many more goods as opposed to a more balanced profile of goods and services. And so we have, as a result, downgraded our economic forecasts for the first half of this year. We still generally think, though, that 2022 will be a year characterized by above trend economic activity. We're looking for 3 to 4% real economic growth here in the United States for 2022 as a whole. And we think that there are really going to be three things that drive that growth when all is said and done. The first is the consumer. Importantly, the consumer is 70% of the US economy. And as we look at the financial position of the consumer today, whether you look at the household debt service ratio, whether you look at the median checking account balance, consumers still look pretty good. They have money to spend, they've reduced their debt load. And so we do think, and we can talk about some of the risks to the consumer later on, particularly from higher energy prices, but our base case view here is that the consumer is going to be a key driver of economic activity in 2022. The other thing we believe is going to drive growth, or one of the other things that we believe is going to drive growth, is a rebuilding of inventories. I'm sure everybody during the holiday season was frustrated by the amount of time it was taking to move things from point A to point B. The reality of the situation is that now there's not a whole lot of stuff left when you look at point A. And so we think that those inventories need to be rebuilt. This is something we saw happen into the end of last year, and we very much believe that that's going to continue over the course of the year as a whole. The final thing we see as a driver of growth in 2022 is business investment, CapEx. And we really think that investment spending is going to pick up for a couple of reasons. One is that if you look historically, there has been a very tight relationship between earnings growth and then capital spending 12 months later. And we're coming off of a very good year of corporate profits. We think that S&P 500 earnings per share grew by more than 70% in 2022. And so we wouldn't be surprised to see that historic relationship play out and an uptick in investment spending in 2022. But there's actually a second leg of that thesis, which is, if you look at what's happening in the economy today, we're seeing rising input prices, rising wages, margins are coming under a bit of pressure. And we've heard from corporate managements that one of the ways they plan on dealing with these higher input costs is through automation and product and a focus on productivity. And so we think that naturally lends itself to an acceleration in investment spending. And again, I think the important thing to recognize here, because we haven't moved past the pandemic, as you stated in your opening remarks, we are getting better at living with the pandemic operating in the background. And furthermore, we're not looking for one part of the economy to be the primary driver of growth this year. We actually think that the growth profile is going to be relatively balanced, which in theory should allow the economy to remain resilient in the face of COVID.
Very interesting. The inflation subject is always out there as well, and we've seen, really kind of wild, herky-jerky moves in different commodity prices. And we always comment on our favorite bacon. Prices are up big. Oil prices are up big. Cars, of course, real estate and assets are up big. And then bandied about the discussion, Chris Reardon, that we've had on the 4-Star podcast about the word transitory, what that means. And is it transitory? Any thoughts on that issue?
So inflation is the word, if you will. It comes up in every conversation that I have. When we think about inflation, we try to put it into 3 buckets, and I'm going to avoid using the term transitory. I'm just going to say that we do not believe inflation is going to be a structural problem that faces the economy over the course of a business cycle more broadly. And so when we think about inflation, we think about what's driving it in the short run, what drives it in the long run, and then what are some of the more nebulous medium-term factors that can impact or influence how transitory or not transitory inflation ends up being over time. So in terms of the short-term drivers, you mentioned a number of them just a few minutes ago. Auto prices up big, energy prices up big, food prices are rising. These are all things that they're very cyclical, right? They ebb and flow. And so, the question with respect to energy, just as an example, is, are energy prices up another 30% 12 months from now, or are they kind of where they are today? Inflation in the energy space can change very quickly, and that alongside the parts of the economy that were hit hard during the pandemic, we think that inflation is transitory. We think that should gradually dissipate over the course of 2022. Longer term, again, we don't believe that inflation is going to be a structural problem. And the reason why is that there have been these 4 structural drivers of inflation. They've been driving inflation lower over the course of the past 40 years. These are things like globalization, technological adoption, income inequality, and demographics. And as long as those 4 forces remain in play, we see it as being very difficult for inflation to really get out of hand the way that it did in the 1970s. But that leads to the obvious question of, okay, so we just had an inflation report yesterday for the month of December. We saw the highest rate of year-over-year headline inflation in something like 40 years. So when does this begin to come back down to earth? Then, I do think that inflation will cool off here over the course of 2022, but I don't think that we will be back down at the Fed's 2% target by the end of this year. I think inflation of 3% by year end is a much more reasonable expectation. And part of what's going to support inflation over the course of the next 12 months is, things like home prices, wages. We're seeing people get paid more. We've seen home prices rise, substantially over the past year, but that is just beginning to show up in the official government inflation statistics. And so we think that we're probably seeing peak inflation as we speak. Inflation should come down over the course of the year to come, but we're not going to end up with inflation where it was in the post-GFC period, at least in my view, until sometime probably around the middle or back half of 2023. So we're going to be dealing with inflation for a while, and that does have implications not only for capital markets, but also importantly for things like monetary policy.
Okay. Chris, did you? Yeah.
Yeah, one quick. So, obviously one of the drivers of inflation, especially in the short term, where kind of you mentioned globalization, it was almost a double-edged sword during the pandemic, right? Because you had the supply chains that just got kind of all the sand in the gears. So I've seen it start to get a little bit better. A lot of the ports are starting to kind of unwind a little bit, but it's still obviously a prominent issue. Can you speak a little bit to that? And then also, are we going to see more investment on, some of that coming more to the America home turf, so you don't have some of those issues, or it's not as exacerbated as much in the future? And maybe that will speak to the business investment aspect that you spoke about in the beginning.
So a couple of thoughts there. It's interesting when you think about tying this back to inflation, because where we're seeing a lot of inflation is in goods. It's beginning to broaden out into services, but the goods sector was basically in deflation for 20 years. And then because of these supply chain disruptions, you've seen goods price inflation accelerate pretty meaningfully here over the course of the past year and a half. I think that supply chains are still a risk. Yes, things have seemingly begun to get better here over the past couple of months, but we do think that there is a non-zero chance that the Omicron variant, given the way it's spreading through China, could, to borrow your term, Chris, put some more sand in the gears of the global supply chain here over the course of the next couple of weeks. China still is adhering to this zero COVID policy, where anytime they identify a case of COVID, they lock down the city, they shut down the port, they shut down the manufacturing facility. And that's a big part of the reason why we're in this predicament from a supply chain perspective, is because of that zero COVID policy and the way that it's been implemented since the pandemic began. So I'm not sure that we can sound the all clear on supply chains quite yet. To your question of, does this cause people to reorient their supply chains? I want to take a trip down memory lane to something that I think a lot of people have forgotten, which is the US-China trade tensions of 2019. I mean, you were actively seeing in that environment companies reorient the way that they supplied their operations through places like Vietnam, through places like Indonesia, taking some of that China risk out of the equation. And you could definitely see more and more of that, given what's transpired here over the past year and a half. But I don't think it goes as far as bringing everything back on shore. And the reason why is because, if we made things like iPhones in the United States, they would be so expensive that nobody would buy them, right? So there is still a benefit to manufacturing things outside of the United States, to taking advantage of that lower cost labor. That low cost labor exists in very different places today than it did, say, 10 or 15 years ago. And I do think that you'll see some adjustments to supply chains in an effort to preserve that cost advantage. But the idea that we completely, re-onshore manufacturing, to me, that feels like a little bit of a stretch. Nonetheless, you will see some of that, and that could very well be an item that supports inflation here over the course of the medium term.
Very interesting. Well, David, in the technology crash back in early 2000, we saw the tech and telecom sectors top out at about 40 to 45% of the overall S&P benchmark. And then by the end, it was down in the 20s again when the technology stocks crashed, went back to a kind of a normal allocation of the index. Well, now between tech and telecom, we're up close to 50% of the S&P 500 index. So, we see that. And then on the other side, we have another indicator we track called the New York Stock Exchange bullish percent. And only about half of stocks are in bullish trends and half are not. So we're trying to figure out, what does that mean for stocks? We see extended valuations, really distorted benchmarks, but yet maybe the market goes a lot higher. I don't know. What do you think?
So it's a good question, and I like the way that you started by framing things in the context of, look, telecom, which is now communication services, and tech is effectively 50% of the S&P 500. A couple of thoughts there. One, the question we always get is, how much of a risk is this? And we look at that market capitalization, and the way that we evaluate the risk is we compare it to its contribution to earnings. So if these companies are half of the index, are they contributing half of the earnings? And the answer is they're pretty close. They're not all the way there, but these companies are definitely pulling their own weight in a way that was not the case in the run up to the tech bubble in the late 90s, excuse me, and the early 2000s. And so, we do recognize that valuations are extended. We do recognize that these are a big part of the market, but there is kind of a safety net there in the form of earnings, which again, wasn't there in the midst of the tech bubble. Now, the other thing I believe is important to recognize is that if those top 10 names, the tech sector and the communication services sector, if we just look at the biggest players in those two sectors, if those names don't do well, then the market isn't really going to go anywhere. To an extent, we are beholden to, these mega cap tech names that have done so much of the heavy lifting over the course of the past couple of years. But I think what's important to recognize is that just because that has implications for the market doesn't mean that the implications are the same for investors. And we're actually finding a lot of interesting things to do beneath the surface of the market. And we believe that the potential for alpha generation this year is much more significant than it's been, since the pandemic began. And, the thought process is take a look at the financial sector, just as an example. So looks cheap on a relative basis. It's been unloved for the better part of a decade. But, if we believe that interest rates are headed higher, and we do think that rates are headed higher, that's a tailwind for financial sector profitability. You look at the yield that these securities are spitting off, if you include both dividends and buybacks, it's something north of 5%, which is very difficult to come by when it comes to traditional fixed income. We think that there are these opportunities like the financial sector that exist in the current environment that investors would be well served to take advantage of. That's not to say that we're running away from things like technology and things like growth, but rather becoming more nuanced in our approach to those parts of the market. And, to us, the primary way by which rising interest rates pressure equities is vis-a-vis valuations. And so on the one hand, we like things like financials where the relative valuation is cheap, right? There's less pressure that can be applied. In the case of those higher flying sectors, the tech names specifically, we want to make sure the earnings are there. Because if rates rise and multiples get pressured, if the earnings are coming through, eventually people begin to see value after things fall to a certain point. And so, to us, cash flow is really king when it comes to the next 12 months. We need the earnings to be there because multiples are not going to be able to do the heavy lifting that they did, say, back in 2020. And we're actually expecting a market at the end of the day, which is very similar to 2021. Last year saw earnings expectations improve by about 35% over the course of the year. Multiples fell by about 8%. That's how you got to a net price return of about 27%. We think the magnitude of these figures will probably be smaller in 2022, but we still think that story of growing into extended valuations is a reasonable expectation to have as we look to the year ahead.
Interesting. Chris, any other thoughts?
Yeah, I mean, one of the last things I'll mention, and see if you could speak a little bit on is, one of the other trends we really saw coming out of the pandemic is this shift within the labor market. I mean, we're seeing, I think, this big gap between jobs available. You hear stories of people don't want to go work at certain jobs. And like you had mentioned in the beginning, part of inflation, we're going to have to see wages start to rise. So can you speak a little bit to that? And is there going to be an end to it? Is it, a balance where once wages hit a certain level, we're going to see it kind of flood back? Or what's your thoughts on the labor market, that coming up?
So, the labor market, really the economy broadly, is being challenged by the supply side. We see it in terms of supply chains and the supply of consumer goods, like we talked about earlier. We also see it in the supply of labor. And, to your point, there's a tremendous amount of demand for labor. There are more job openings than there are unemployed individuals
Yes.
here in the United States, right? The problem is people haven't necessarily returned to the labor force. And we think there are a couple of things that are going on here. The first is that a decent amount of labor supply has not come back because it has not had to. Going back to my point earlier about the consumer, you still have people sitting, on relatively healthy cash piles. They say to themselves, you know what, I'm not going to go get a job because I don't need a job right now. But at some point that cash runs out and those individuals will come back into the labor market more broadly. The second thing we think is going on here is a bit of a skills mismatch. If you looked at the labor market before the pandemic, what you would have seen was that 80% of the jobs in the United States were in services and 20% of the jobs were in manufacturing. Now, what's the part of the economy that's been firing on all cylinders? Manufacturing. What's been under pressure? Services. You can't necessarily take a bartender and put them on an assembly line making consumer goods. They might be able to make a mean cocktail, but they probably can't make a widget. And so the skills mismatch is something, and you can see that in the survey data as well, particularly amongst small businesses. Hey, I posted this job, some guy applied, he showed up and he had no idea how to do what I was potentially going to hire him to do. And then the third thing we think is going on is relatively specific, but the female labor force participation rate fell by about twice as much as the male labor force participation rate as the pandemic took hold, and it really hasn't shown any signs of recovery. The reason why is that childcare is still a significant issue for a lot of families in the United States. We were dealing with it just last week as Omicron has spread. We got an email on Sunday night saying, hey, like school's canceled tomorrow because we can't find any teachers to come in and teach. That meant that we had to keep our daughter home. We're very fortunate that we have family around the corner that can help out, but not everybody's in that position, and childcare is still a significant issue. And so there are things that are weighing on labor supply in the current environment, and that's part of why you're seeing wage growth accelerate to its fastest pace since the early 1980s and late 1970s. But again, we do think that will come off the boil over the course of the next 12 to 18 months. We do believe that labor supply will come back. We may not get all the way back to where we were pre-pandemic. We have seen a significant amount of retirement over the course of the past couple of quarters, but we will get some incremental labor supply here, and hopefully that turns down the temperature, particularly as it pertains to wage growth in the current environment.
So David, thank you. Chris, we did talk about on the podcast this whole issue of the record number of people that quit in November, right? And Chris, maybe David has some thoughts on that. Is that kind of the same idea, that a lot of ladies leaving the market and that kind of thing? How did we get that big quit number in November?
So the quits question is an interesting one. Potentially some of it was a function of the childcare issue. I actually tend to look at the quits rate more as an indicator of confidence. Why do you quit your job? Because you think you can get another one that pays you more, right? You don't quit when you think your prospects are lousy. You quit when you think, you're doing one job and getting paid $15 an hour, but the guy across the street will pay you 20. And so to me, it's reflective of, the tightness of the labor market in the current environment. Again, I do think things could loosen up here as some of this labor supply comes back. But to me, the issue around quits is directly in line with everything else we're seeing, which is that labor supply is limited, wages are rising, and workers are actively taking advantage of a dynamic that hasn't existed, for the better part of a decade here.
Interesting. But one thought I had, a very interesting strategist, you might know who this is. Well, first of all, military generals are always accused of fighting the last war. And so trying to figure out how to solve the problem that happened in the past. And investors do a lot of the same things, right? So 2007, we had record levels of consumer debt, record levels of debt at all levels, real estate crashing, multiple people buying 3 and 4 homes on the same equity, all kinds of just bizarre things going on. And so then there's a sense, well, this time is different. But in some ways, this time is different because there's a lot of cash out there. So is it that different? Are we in an environment where we're not really topping out in the economy, rolling over like in 2007? Are we really in a recovery for a period of time? Very possibly.
I think so. I mean, I think that there is a clear risk that stems from policy broadly and monetary policy in particular. I am a little bit worried that the Fed is reacting to what they're seeing in the inflation data today, rather than thinking about kind of what lies ahead. I call it the Wayne Gretzky theory of central banking, right? We want to think about where the puck's going, not about where the puck is right as we speak. And so I do, worry a little bit that the risk of a policy error by the Fed is rising. But, I'd come back to what I said earlier. When we look at the drivers of growth or the potential drivers of growth this year, it's a relatively balanced distribution. We don't really see excess in the economy the way that we have, towards the end of cycles historically. Yes, there's a lot of debt out there, but it's primarily government debt at this point. And in a world of very low rates, it is possible to service that debt for the foreseeable future. And so I generally think that the road ahead of us is relatively extended. I do think, though, one thing that investors need to recognize is that over the course of the next 18 to 24 months, at a minimum, the nominal story is going to matter. We became obsessed with this idea of focusing on real growth during the prior expansion because there was no inflation, right? There is inflation today. That's a problem if you're a consumer. If you're a business, it's just another word for pricing power. And so when we think about the outlook for capital markets and we think about the outlook for corporate profits, we're actually not rubbed by the inflation environment we're seeing today, we think that as long as the Fed doesn't make a mistake, the runway ahead of this economy is pretty decent, and there is still money to be made, particularly in risk assets like equities.
Interesting. Now, in our pre-discussion, when we were just talking off the record somewhat, we talked about how coming into this year, it looked like we were accelerating. Now things are getting a little sloppy with Omicron, and maybe growth is big, but maybe not as big as it was. And if that's still true, does that change the kind of investments we might look at and the kind of groups we might invest in the market?
So I think that to an extent it does. When we thought that the economy was going to have a lot of momentum kicking off the year, we were more inclined to not swing for the fences, but to try to hit a triple. To own those companies and those sectors that are highly levered to the pace of economic activity. Think of the industrial sector, the materials sector, the energy sector. We were really willing to embrace beta in portfolios. We've become a little bit more nuanced. We recognize that we've gone from an outlook of, above trend growth and relatively robust growth served with a healthy side of inflation to growth that is still above trend, but more moderate compared to what we were expecting with arguably the same amount of inflation. And so we want to focus on those businesses that should be able to navigate that type of world. And again, it leads us to take some risk off the table in terms of the types of companies that we own, but we still very much believe that stocks look attractive relative to bonds. And we're relatively balanced when it comes to growth and value. We're finding things on both sides of the ledger that we can take advantage of. And I think that's going to be the key to success going forward. There is a tremendous amount, I'll say it again, tremendous amount of opportunity beneath the surface of the equity market. And that's where we plan on spending more of our time looking here over the course of 2022.
Interesting. So Chris and I review on our podcast every market commentary episode, what's up, what's down, what groups are trending in broad-based asset classes, and then drill down sectors. And Chris, isn't commodities one of the strongest areas right now?
Yeah, commodities was the biggest winner 2021 for us, and it's continued to be strong. I think primarily driven coming in 2022 by oil. Oil kind of took off again. I think with expectations, the Omicron variant is going to be a little less elongated, I guess you could say, as was expected. So, but yeah, commodities, I think it continues to be strong. I don't know if you want to speak a little bit to that, David.
Sure. I think that it kind of ties back to what we talked about earlier in terms of the supply chains and the consumption of goods. Moving this stuff and getting it to where it needs to be has become increasingly difficult. That has subsequently pushed up the price. And furthermore, if you think about goods versus services, well, goods are much more commodity intensive than services. You may need to fill up your car with gas to go to your job as a waiter or a waitress. But once you're there, it's kind of on you. If you're building a video game console or you're building a car, right, it's kind of all about the raw materials. And so I think that that's a big part of what drove the move in commodities last year. I also think that the inflation narrative led some individuals into that asset class looking for protection, and that to an extent can become a self-fulfilling prophecy. The question from my vantage point is where do things go from here? And we still see value in certain parts of the commodity complex, but not necessarily the complex more broadly. And one of the things that we've spent a lot of time talking to clients about when it comes to commodities is investing in things like copper. So people tend to think of copper like, oh, it's kind of a dirty metal, right? It's an industrial metal. Actually, copper is an essential input into renewable energy technology. If you look at the amount of copper required to build a wind turbine, it is substantial. And so we do think, particularly in a world where ESG is in more focus, sustainability has very much become a buzzword. We think owning commodities that can kind of bridge that gap between where we are today and where things are going over the course of the next 5, 10, 15 years is really going to be the recipe for success. I'm not going to make a big bet as to what oil prices are going to do over the next 12 months. I frankly think that we're still a world awash in oil, but what I will make a bet on is the idea that we increasingly embrace renewable and more sustainable sources of energy over the course of the business cycle more broadly. So again, I would say that the commodity view dovetails quite nicely with our equity view in the sense of, we're still comfortable expressing a pro-risk position using those types of assets, but the individual assets that we're willing to own has become more specific as we look ahead to the coming year.
Well, David, we haven't really had a strong commodity cycle in the financial market since 2010. We saw a little rally in 2015. And so this rally we've had in the fourth quarter was really the first one we've seen in a while. And our experience is that the commodity rallies, they may go on for a while, but when commodities are rallying, it's actually an input cost into the economy. So it's not really a positive thing necessarily. So they're kind of short-lived. Do you think this will be a relatively short-lived commodity cycle?
I do. And I think that, a big part of what drove the commodity super cycle in the early 2000s was the industrialization of the Chinese economy. A real focus on manufacturing, tremendous amounts of demand. You're not going to be able to reprise that. There may be more demand from China than we've seen over the past couple of years, but the idea that we repeat that early 2000s episode to me feels like a stretch. And so, does the commodity cycle short itself out, by the middle of this year? I think it probably has more legs than that. But, do I want to be owning commodities for the next 10 years? I think that that's probably subject to a little bit more debate and discussion.
Yeah, it's interesting. And last year, if you didn't have energy and the materials sectors, you didn't beat the S&P for sure. And that's continued a little bit this year. But my sense is it's not going to go on forever. But if we don't play ball there for a little bit, we're going to have a hard time beating benchmarks, right? So
exactly.
They're more trades than investments, really. It's productivity technology and other areas eventually will recover, probably.
Exactly. And we spend a lot of time talking to clients about the idea of, owning growth and renting value, owning the sectors that should benefit from above trend economic activity when you have that above trend economic activity, but simultaneously recognizing that, over the course of the next 10 years, tech is probably where you want to be. And interestingly, tech is making its way into the more cyclical parts of the market. And, fintech is a great example of the merger that we've seen between technology and pretty much every sector in the S&P 500. And so, we oftentimes talk about the idea of not fighting the Fed. Let's not fight technology either, because to your point, it improves productivity over time, which is a key driver of economic growth. And, productivity growth has been missing really for the better part of the past 10 years. I know it improved around the pandemic because there was all sorts of funky stuff going on with the composition of the labor force and so on and so forth. But in order to drive a real parallel shift higher in productivity, we need to continue to embrace technology. And that's why it remains a key long-term holding in our portfolios.
So we're in a brutal technology market right now, but eventually things will turn around. And if you own a lot of commodities, enjoy the ride, but keep your sell tickets on top of your desk and not in a drawer.
Exactly.
Excellent. So Chris, did we vet everything out? What do you think?
Yeah, I think that covers a lot of the questions that we had.
Yeah. Any parting thoughts here, Dave? What do we have to do in this great recovery and Omicron, whatever we're calling this thing?
Yeah, to me, the thing I would like to leave all of your listeners with is that a lot of the easy money has been made. And 2022 is going to be more challenging than 2021. Something that really struck me the other day was if you look at the peak to trough decline for the S&P 500 last year, the maximum drawdown was only 5%. That is effectively a third of the realized volatility that we've seen on average over the past 40 plus years. And I think to me, higher volatility really just represents a wider distribution of outcomes. It means that investors are asking a lot of the questions that we discussed here today. How should I be thinking about inflation? What's the outlook for economic growth? Should I be worried about the commodity complex and rising input costs? These are the questions that create uncertainty and drive volatility higher. And so we very much are expecting a bumpier ride this year, but we do believe that corporate profit growth is going to remain solid. We continue to believe that over the long run, equity markets are resilient. And so we think the big question facing investors today is, are you positioned in such a way to deal with this volatility, which is inevitably going to show up? Because the key when volatility begins to rise is the ability to stay invested when the water becomes a little bit choppy. So prepare for some bumps, but recognize that the overall view remains pretty constructive, despite what's happened here over the past couple of weeks.
So we'll advise our investors to steel your nerves, hang on, and make sure you have your seatbelt on.
That sounds good.
Sounds great. All right. Well, this has been great. Thanks again, Eric and David, for joining us here on the 4-Star podcast. And we'll be sure to check in with you again, maybe later in the year, and see if we can get any more insights then. So thank you, and welcome to 2022.
That's great. Thanks so much for having us.
Thanks, everybody. Thanks again for everybody being on the 4-Star podcast, and we'll be back very shortly.